Craig Swanger is from FIIG Securities. He's in our Sydney CBD studio for you. Craig, warm welcome into the show. Maybe we start by just the language today versus what comes potentially later this week. Are you believing too much emerges by way of projections, or the RBA hedges its bets and doesn't tinker too much with its accompanying statement?
Look, I think they're really stuck between a rock and a hard place at the moment. You know, on one hand, there's no doubt that the Australian economy has some real structural challenges to get over, and that's the medium to long-term focus for the RBA. On the other hand, the inflation figures really surprised on the upside towards the end of last year. Now, there's some early data that's come out, monthly data for January, that shows that maybe inflation for the first quarter will be a little lower than where we saw at the end of the year, but it's a very difficult position and a very narrow road for the RBA to try and walk down. I think where they'll be talking today, you won't get any really strong indication of the next move. In fact, quite the opposite. I think they'll be giving a clear indication that they're very cognizant of the risks to the economy and also the risks to inflation. But for the meantime, we're looking at rates staying where they are for the foreseeable future. One thing that I think will be very interesting is the commentary around inflation itself. So if you remember back to the November forecast that the RBA gave for 2013 inflation, they were forecasting an inflationary figure that was 2.25% for the whole year of 2013. That's November. By the end of the year, we saw actually it was 2.6. That's a very large margin. And they won't be wanting to be seen not to be on top of where inflation's going. So I think in terms of the volume of commentary and the signals that we'll see, it's all going to be about where do they see the risk to inflation over the next 24 months or so.
One of the perverse things is that with an elevated Australian dollar, i.e. when it was closer towards parity than it is today, it was helping their inflation fight. And yet it's been at pains to do the opposite in its commentary, referring to it as uncomfortably high, which only compounds its headache. It's as if, well, why give yourself that headache if you really don't want it?
Yeah, and that's a very good example of the problem they face. So we really need a more competitive Australian dollar for Australia's economy to be able to get through these structural changes, from the mining investment phase and through to a phase in which the eastern seaboard is able to do the economic heavy lifting. Now, at the moment, unemployment, particularly in Victoria and Queensland and South Australia, is really starting to step up. Certainly nowhere near alarming levels yet, but we're talking about increases of nearly 2% since the 2007-8 lows. So that'll be very much front of mind for the RBA. But at the same time, while they want a lower Australian dollar, if it falls too fast, it creates inflation volatility. Inflation volatility is worse than inflation in a lot of ways because it scares people. It impacts on confidence, and that's what can really drive a decline in investment.
What's your view that the overseas component of the story that is still propping up the Australian dollar, if we get a smaller scale US recovery than we anticipated, does that force the RBA's hand unwittingly to cut and go against now market consensus, i.e. the taper timetable stalls and the US dollar remains artificially propped up by hot offshore money?
But there's 3 points in here, and they actually all point in different directions. If tapering does slow beyond current expectations, for example, then there's more liquidity in the global markets, and that liquidity has been finding its way into emerging markets and is finding its way into Australian markets. So yes, it's been propping up the Australian dollar, but it also tends to, ironically, dampen volatility in the markets that we look at. On the other hand, a slowing and tapering probably would be driven by weaker than expected US economic results. And that's going to see, again, the somewhat ironic flight back to safety of the US dollar and have another impact on the Aussie dollar. And then there's actually the third scenario, which really isn't talked about that much, but over the medium term, the US economy is actually making some fantastic structural changes.
Well, yeah, just on that point before the structural changes, you are of the belief, are you still, that weak US data will mean strength in the greenback? You're certain of that?
Well, no one's ever going to be certain about foreign exchange markets, and you certainly don't want to listen to anyone who is. But what we've seen for the last few years has been a weak US economy scares investors, which sees a flood back into US dollars and US markets. So if the trend of the last few years continues, and driven by the fear side of investor psyches, then yes, that's exactly the result we'll see.
And yet surely now that pendulum has swung, has it not? I.e. strength in the data fortifies those that believe the taper timetable continues, and therefore it's more attractive to park your cash in the States, and it is supportive, i.e. strong data, strong greenback.
Exactly. Strong data, more specifically a bias towards rising interest rates in the US, and that will see a rise in the greenback, for no other reason than the yield play starts to wind off on other currencies.
But that is the point now, though, that the fact that the data looks to be kind of stuttering or sidelined in part. The new orders of the ISM was telling, and the jobs numbers last week, it's almost you could blame the weather in isolation, but now when you get that ISM compounding the picture, it's very hard to blame the weather, isn't it?
That's exactly right. I think even seeing the volatility in equity markets for the last month and the knock-on impact that has in the investor community, already we're starting to hear commentary about the debt ceiling again and the fiscal situation again. So that negativity comes back into the commentary, and that starts to cause an issue with confidence, which then flows through to the economy. So this is a really bumpy road to recovery for the US, and that's flowing on to markets like China and, of course, our own.
Craig, are the bank bill futures markets, are the money markets running now too far ahead of the RBA for your liking?
No, I think, generally speaking, they're on track. So I think if you look at markets that have probably run a little ahead of themselves, we've seen the risk of that in the equity markets during 2013, and they've really come back quite strongly. But generally speaking, I think the futures markets and interest rates are getting at about where I would expect interest rates to be going for the next 18 months or so.
And they're making enough assumption, though, for that unemployment rate maybe going above and beyond everything that you've talked about with, the Eastern Seaboard needing to do heavy lifting. But if it stalls, unemployment presumably will only go potentially above a 6.5% handle.
That's right, and that's where the RBA is going to get really going to have to play its cards, because a 6.5% unemployment rate certainly is a very good reason to at least leave rates where they are, if not ease one more time. On the other hand, a sudden fall in the Australian dollar will cause shocks to the market that could actually drive inflation up. And of course then there's the worst case scenario, which is we see both.
Probability of it happening? How high?
I don't think the probability of both is very high, and in fact unemployment, I think in Australia there's still a latent demand that will see our structural change go through relatively smoothly. The risk factor, I think, sits with inflation. We can't control our foreign exchange markets. We can't control the Australian dollar.
Well, we could put capital controls in place, but the government won't do that.
Yeah, and that's not worked out terribly well for other economies around the world.
All right. Doesn't mean to say it's not theoretically possible, though, right? Craig, thank you so much.
Thank you.
Craig Swanger from FIIG Securities in